What that microeconomy tells you is whether it's a good time to buy, because we have season, a time to buy, but there's a saying that you always keep buying at any season. That's the truth. I buy at every time, but I know my requirements or my limits are different at each period. When I'm in a period where I'm not supposed to be buying, then I have to be super conservative. That's not the time to be aggressive. And those are periods we just passed. Those periods that people were buying their properties very high. 2020 and 2021. Those are periods people were buying properties double the worth, and we see them, they are foreclosing now. So periods like that are periods when the market is hot. It's not really a good time for you to jump into it. But I jumped into it, and the 2 deals I closed in that period are one of my best deals, for crying out loud. And that's because I bought them at what it was worth. It was difficult. I spent 1 good full year plus to get those deals. Today, we'll be talking about underwriting. I know some of you are here because of it, and the reason why we decided to do this is mainly because I've been receiving so many calls lately about underwriting. But for some of you, you've had the misconception that underwriting is more about spreadsheets. But I am very sorry to disappoint you that underwriting is just some aspect of the spreadsheet. There is more to it than just the spreadsheet. So we're going to start from the beginning, and also we will go through it. But I'm sorry to disappoint some of you. It's not a one-day course. You can't learn it today. Anyone that tells you can learn underwriting in 1 day, I can assure you that that person is not telling you the truth. And for me, it took me time to bring myself to doing this, not because I do not want to share knowledge. For some of you that have been attending our webinar, you know that that's not the case. You know, I always like to share knowledge. But the thing about it is that it's a stressful process. And some of us have heard about the 2 minutes underwriting or napkin underwriting or the 10 minutes underwriting. In my case, it's difficult for me to do 2 minutes and 10 minutes underwriting. And let me tell you why. One of the main reasons why I tend not to do those type of underwriting is because sometimes you might lose details just because you are just going that way. Like I said, spreadsheet is not just underwriting. There are so many things. So I've gone through that process, and I found out that a deal that looked bad, by the time I got the entire information, the deal was maybe one of the best deals I've ever underwritten. So, and that thing kept on happening to me. I kept throwing out deals until I said, you know what, maybe I'll take a deeper look at deals, even if it's going to take me some time, because the more you do underwriting, the faster you become. But at the beginning, it might look like you are doing a lot and all that. So in this case, this is me. I'm teaching you with my own experience. So I'm going to tell you what worked for me, and you can go with it or you decide to leave it. So for me, what has worked with us is I do somewhat type of deep underwriting, not as deep as it should be, but an underwriting that tells me is a go, at least in the first instance. So what are we underwriting to? We are underwriting to projections, you're underwriting to previous trends, you're underwriting to current. So you're doing the previous, you're doing the current, and you're doing the future. So most of the times, what we do in underwriting is more projections, and it's really wrong. And that's why you see deals fail, because you have to take cognizance of the trends, what has happened in the past, and that will give you an idea of what to expect, why today is like this, because many things that have happened today might have been as a result of things that happened yesterday, and things that will happen in the future will also be as a result of things that are happening now. So if you don't understand those trends, there's a probability that there'll be an issue. So that's why I'm saying, and I'm re-emphasizing it, that underwriting is not just spreadsheet. So for those of you that came here today about spreadsheet, we're going to dive into it. There's no problem. We're going to do it. So enjoy yourself. But my point is that that is not all what it is. And the moment you understand the process, that is how easy it will be for you. And even if you don't intend to be an active investor and you just want to remain a limited investor, this is important to you. Many limited investors have lost money, including me, because I try to diversify. I do my own deals, and I decided that, okay, let me not just depend only on my deals. Let me invest in some people's deals. And I'll tell you for a fact, I lost all the money. Apart from one. There were 3 deals I invested in, 2. Only one is standing. Okay, someone is saying here that he has lost about $1 million plus. And that is why this is crucial for you, because once you understand the secret and know what sponsors do and know how they come about their numbers, you will learn to say no to deals or say yes when you need to. So that is why this session is so important. It's really very sad. I'm sorry that you guys have lost money. I've equally lost money, but I will not tell you that multifamily is bad. Some of you have lost the zeal too. So in underwriting, in order for you not to lose money, the things that we look out for is, first of all, the market. The market is one of the most important aspects, and that's what some of us don't do. We just get a broker randomly and the broker gives us a deal and we just accept it. I don't invest in all the market, and let me tell you why. For you to start up with underwriting, first of all, you have to understand the market. And it works both ways, not just for limited partners, but also for active partners. You have to be in a market that you know as a limited partner and as a GP. It's important that you get that right. So if someone brings a deal for me and they say the deal is in Atlanta is a good market, but I cannot invest in Atlanta. You know why? Because I don't know the market. How do I invest in something that I do not understand how they assess taxes, how the law for eviction is? I don't know anything. So those things are very important for me, and it should be important to you as an investor. And if you are new in this, my suggestion to you is please start with one market before you dive into two. I started with 5 and I regretted it. So I had to streamline it to 2. We had to start selling other properties and we remained in 2 markets. So that's what we had to do. So my primary market right now is the Texas market. And even in Texas, I don't invest in all the markets because not all markets in Texas that is good. You have to also know that. So there's some parameters or radius that I can't go beyond. And that is very important so that I save myself. And that is because for me to go into a market, I have to study the market before I dive into it. And that is what everyone should start doing in looking for a market. So I am in the Dallas market, and the first thing for you to do is market research. And what are you looking for in a market? Because all these things are going to go into your underwriting. So you have to know the market for different things. You have to know, one, these are the fundamentals. The fundamental of multifamilies are the things you'll be looking for in that market. One of them is, what is the growth? One of the things you need to look at in that market is, what is the growth level? What's the population like? What's the age group? Who are the people staying there in terms of the age? What is the median income? What are the jobs that are in that market? So for example, a broker 2 weeks ago sent me a property in Killen. The vintage is 2016. When I say vintage means the year the property was built. The broker gave it to me and I said, oh, sorry, I can't invest in this market. And he asked me why. I said, because it's for military. So if I get a property in that market, I know that the major employers, the military, and these guys are always deployed, and not even in this period where we are seeing militaries in almost every state and all that. So it's important that you understand that. So when he immediately told me that the employers are from the military, that was a no-no. So that is number one. I'm looking for who the employers are. They must not be 1 or 2 major employers. I need multiple people, employers, for me to be there. Because one thing about job is that the more jobs you have, the more people you see there. So I'll be looking for the employers. I'm also looking for the employees. How many workers do they have? Because when we have businesses in a location, they employ people. The people now stay in that location. Most times people tend to stay close to where they work. Rarely do you see people staying very far. And if they do, maybe for other reasons. But majority of people want to stay around the area that they work. So I need to find out the market. I need to find out the employer, the employees. The employers must be multiple. I can't have 2 employers or 3 and say goodbye. No, that is the end of that deal. I'm not moving an inch at all. The third thing I'm looking at, who are the people there? What's the age group like? First of all, if I'm buying a house and the age group is, let's say, 16 to 30, I know it's a student area. I'm likely not to buy it. If I'm not interested in investing in student housing, I won't buy it because that's not the age group that can afford my kind of house. I'm looking for family life. But if I'm interested in students, once I see that median income of maybe 16 or 18 to 32, I know these are young people. I know that my market is there. But when I start seeing from 32 to maybe 80 something, I know that yes, the working class, they are all there and they are able to. Now, that is not enough for me to say I'm going to buy that property. The next thing I have to do is to ask myself, how much do they earn? So for some of you that do not understand, for good property management company, or if you are owner operator, there is a criteria we use to vet prospective tenants before we put them on our property. They must earn 3 times the rent in a month or 2.5. We don't go lower than 2.5 in a month. Their wages, their salary, whatever that is, must be 3 times or 2.5 times the income. So you guys will be wondering, okay, Bibi, can you go straight to the numbers? No, I won't go straight to the numbers because these are part of the genesis of the problems that people face because of criteria that they tend to sweep under the carpet. I've seen many people, especially people that tend to manage these things themselves. They don't ask those questions. They don't do background check. Are you guys aware that people do pay stub? If you're not aware, know that. Are you aware that they forge fake documents? We've seen a lot of that. So the systems you have in place, especially if you're using a good property management company, those are the people that will help you sort that out. So like I said, the first underwriting you are doing, you're underwriting the market. So imagine if you want to start investing in 6 markets. That means you have to repeat this thing I'm saying 6 times. But if you decide to remain in one market, the tendencies that for you to repeat that process is unlikely, except if things are significantly changed in that market. But if at all things have changed, it's going to be a minor check you'll be doing, unlike when you're going full force, unlike when you're going the first time. So those are things you should be doing. Don't invest in every market. Every market is not for you. Know your reason why you're investing first. First of all, if you're investing for cash flow, look for markets where we have those cash flow. Some people want to invest to just stack up their money. They just want to save their money. They're not really interested in cash flow. They want appreciation. If that's your purpose, you know where to go to. So you have to understand what your criteria is before you give every Tom, Dick, and Harry, including BB, your money. You have to know that before you do that. So for me, I personally chose 2 markets because one, I wanted one that could give me massive cash flow. And that's why I went to PA. And again, not all parts of PA. You also have to know the part of PA you're going to. So I went to the part of PA that is kind of rural, conservative. And those kind of PA, we have a lot of operators there that are mainly husband and wives. And I like those kind of markets because they tend not to push rent up. They leave rent for years, the way it is and all that. So that's why I'm in that market, because of massive cash flow. I don't know if some of you have seen one of the posts I did. We bought a property in 2023 because the location is cheap, the rent is high. Imagine a rural area, they're giving them $25 per hour. You should know that that is cool. In California, it's $15. That's what the government pays. That place was $25. Yes, it's a rural area, but their median income average 75. So most people earn 75 to 120. That is good money, not 45. So that means they can pay. So I bought that property with that mindset that these people are earning so much. Forget that they are in a rural area. That's not what I care about. I care about the job, how much they are earning, how old are they, the migration, how often do they move, because people move. So those are things I checked before I said, okay, this is a good market for me. I'm here for cash flow. Now, another negative is for you to sell can take you longer time. In Dallas, it can take you like maybe 6 months to sell, but in that place can take you like a year plus. So if you want to sell like in a year time, you have to start putting it in the market now. That's how it is. So that has its own downside. But in terms of cash flow, it's powerful. Then now let's go to why I'm in Dallas. Dallas is a market that helps get me the 2. But because of the rate of competitions, because the higher the demand, the higher the amount, right? So because 50 people are competing for one property, the seller now becomes very, very greedy. And from maybe 12 million, they take the price to 18 million. I've seen it happen live. And you're wondering, why are they pushing the amount? Because people are the ones helping them push it to that level. So because of that, I'm aware that in Dallas, I might not be able to get as much cash flow that I want, but I know I can get appreciation. So that is why I'm in those 2 markets. You have to do the same thing for yourself. What do you want? Look for that market and take it. So you have to know what you want. I'm in this market for cash flow. I'm in it for that. Then you have to also look at policies, zoning and all that. Let me tell you something that just happened to us. You guys might think it can never happen. It can happen. We noticed our utility bill increased on one of our property just 3 months after we closed on it. We noticed that it increased, and in our group, we track numbers. Once something goes off, we know. Now, the issue might be that the property manager might not be fast to dictate it. And most times we don't allow it. We're always on top of it. But sometimes you might not remember to go back and still follow up on that. But when that thing happens, as soon as a price of something goes off, because we do constant monitoring of our deals, we always know. So we noticed that our deals started going up in October, November, December. First of all, we had leakages. So all our mind was, okay, maybe the leakages are causing it. Then we started seeing it double, triple. From 6,000, it became 9,000. 9,000 became 14,000. That wasn't leakage again. Something bigger happened and we had no clue. So we decided to call the utility company that what is going on? We checked the bill and your rate has increased 100%. Why? Is this an error? And they said, oh, we just made an ordinance. Ordinance is a law that they pass. But in this case, it was more for the people in that area. It's in a particular county. So they had that meeting over and over and they finally concluded on it in September, and in October it happened, and from 0 our utility bill went up to 100%. For a 6,000 10,000 utility bill, now it's 14,000. So these things are real. Zoning, counties, those things can affect you. Now the thing is, what is your next action? That one, we'll talk about that. But I can tell you for a fact that we're upset that it happened, but these things happen. Policies affect, zoning affects. They can change the zoning, and what do? So you're also looking for a state that is stable, that they don't just change laws and rules as they please. Or maybe it's a purple state. Maybe if there's a blue governor there, they'll bring their own rule. When that blue governor does his term, he goes, a red governor will come, undo it, do this. You don't want to be in those kind of scenarios because you'll be in trouble. And these are things that we are seeing happen. So this happened to us, although we've come up with a plan that will benefit us in the medium and the long term. But in the short term, we'll have to bear a little of the cost, and we're passing it on to the seller. And the reason we have to bear a little of the cost is so that we don't have tenants leaving. We have to pacify them and make them embrace it before they accept it. That's what we're going to do. And those things have tend to work. But my point is, another thing that can affect you is policies. You want to know what the eviction is like, because tenants will be tenants. For the fact that they came in, you did their background check, they are good, they have good money in their account, does not mean that they cannot owe you rent. I did a video about 140,000 might be the new poverty line. If you've not seen that video, go to my YouTube page and watch it. On that video, if 140 is your poverty line, it means that it just takes one very funny sickness or for you to be unemployed and you are disorganized and you don't have money again to pay your rent or pay your mortgage. So that's what we are saying. People that have been loyal, constantly paying their rent and they've never defaulted, just because maybe they were working with the government on all that, or working with a contract company that was working with the government and they dissolved them, they lost their job. We are seeing them not paying their rent. So you have to understand the policies and also create strategies in case something happens. How do you mitigate it? Those are the things. So those aspects are underwriting on its own, because you're going to use it to do your numbers, and I will show you when we get into the numbers. So that's for that. Then the zoning, what's the eviction process? How soon can you take out a tenant? Does the law favor tenants or does it favor the landlord? You have to know that in California, it took me almost a year to take out a tenant. In PA, it took me 25 days to take out a tenant. In Dallas, it takes about 30 to 45 days to take out a tenant. So you need to know all this and know how you can fit in. Do you want to be in a place where a tenant is not paying rent for 1 year? No, nobody wants that. So that is that. And you have to put all this. It's going to determine your vacancy rate when you're doing your underwriting. So this is more critical than even the numbers itself, because these are things that are shaping your number. So the first thing you're doing is the market. Now, the second thing is, once you know that the market is good, you will now go to the property. But before we go into the property, the market is divided into two. There's a macro and a macro market. One is your immediate market. One is external, other market. So the immediate ones are the ones I just mentioned. Things like job, age, those things I just mentioned now are the micro market. Then now the macro are things that are beyond you. You don't have any control over. Those ones are like the policies from the federal government, interest rate. Those are the external markets. Cap rate, those things are external factors that affect you directly. So you also have to underwrite for those things. There are some markets that if interest rate goes up, the cap rate will just expand. And you know, when the cap rate expands, the value of the property will go down. So for example, I'm going to use my market again. In PA, there was a period during the time houses were very high in 2020, 2021. The cap rate was about 6 to 6.5. Last year, we saw it at 7, 7.5, 8. But in Dallas, maybe if the property is unstable and has some issues, that's when you see maybe 7, 8. But a standard property with just normal issues, we're seeing it for at least between 5 to 6.5. So that just tells you something, that properties in Dallas during the same period, despite the fact that the interest rate is high, properties in Dallas is likely to be more expensive than the properties in PA because of the cap rate. So the cap rate is another thing you need to look out for. As a seller, you're looking for places where cap rate can easily shrink. And that's why we still see people in the Texas market, because cap rate can easily shrink and can easily expand, but can shrink if everything is fine. And once it shrinks, that means value go up. Markets like PA, it can easily expand, right? And it's just because of different reasons. The demand and supply plays a major role in that. How many people are demanding for it versus how many people are demanding for it here? So these things you will, because doing your exit strategy, you have to factor in how soon you can get out of that deal. That is why this is important knowledge for you. And that is what underwriting is all about. Someone is asking me, me, can I explain cap rate in more details? I have a video that will explain to you properly what cap rate is, but I'm going to say it in a summary. But if you need detailed explanation in it, I will advise that you go to the YouTube, scan the QR code and go. But cap rate is how a property is valued. So we have two types of cap rate. One is the market cap rate, one is the property cap rate. And the market cap rate is the one that you should be more particular about. People concentrate more on the property's cap rate than the market, and that is why deals are failing. Now, what's the difference? What the property cap rate tells you, cap rate is NOI divided by the purchase price. So now I bought a property for 13 million, and NOI is net operating income. How do you get net operating income? Net operating income is income minus expenses. That's your net operating income. So that NOI that is left is the NOI divided by the amount you bought the property. That is the cap rate of your property. When that thing is high, like 6%, 7, 8, 9, what that tells you that if you are calculating the one for the property, it tells you that that property is cash flowing very well. It tells that property is doing well. And those are the information that brokers normally give to people. The brokers will tell you, oh, this property is 7 cap, 8 cap. Try and understand what they are saying. They are not telling you the other cap rates. The cap rate they're communicating to you is that the property is cash flowing, but that is not your concern at this point. Yes, it's part of it because you want cash flow, but you also don't want to buy a property more than it's worth. You don't want to do that. So the other most important one as a buyer or as a seller that you should concentrate on is the market cap rate. And really what determines it is the market, not you. You have no control over it. That is one of the macro markets I was talking about that is there just beside you, but you have no control over it. But what can you do? You can mitigate the effect. So that one is the reverse of the other one. That one, if it's expanding, let's say 6, 7, 8%, what it tells you is that your property is losing value. Once you watch the video, you understand it very well. The property one tells you your property is cash flowing. That means you're producing cash very well. The more it goes up, the better the income. But the other one tells you that the more it goes up, that means that property is losing value. As a buyer, you want to buy it when it's losing value. That's good for you as a buyer. But as a seller, you want to sell when it's shrinking. So depending on what side of the spectrum you are, that's how you determine what suits you, right? So that is for that. So please watch the video, and when we start the full underwriting, we'll dive into that. My role here is to ensure that every one of you, and apart from other reasons, is really sad because I put out a video 2 weeks ago on underwriting, and I know the feedback I got from it. I got so much views on that video, and people reached out and said, please, I really want to learn underwriting. And it's something that I've been trying to avoid not to do because of the time. I have to pour it all out to you. So, but I told my team, I said, I don't feel like doing this, but I want to teach them. But it must count for me for something, for me to go the extra mile to do it. So I'm going to discuss that aspect shortly. Now, going back to what I was saying. Now, the macroeconomy is that market. So you're underwriting the macroeconomy, the effect. So what that macroeconomy tells you is whether it's a good time to buy, because we have season, a time to buy, but there's a saying that you always keep buying at any season. That's the truth. I buy at every time, but I know my requirements or my limits are different at each period. So when I'm in a period where I'm not supposed to be buying, then I have to be super conservative. That's not the time to be aggressive. And those are periods we just passed. Those periods that people were buying their properties very high. 2020 and 2021. Those are periods people were buying properties double the worth, and we see them, they are foreclosing now. So periods like that are periods when the market is hot. It's not really a good time for you to jump into it. But I jumped into it, and the 2 deals I closed in that period are one of my best deals, for crying out loud. And that's because I bought them at what it was worth. It was difficult. I spent 1 good full year plus to get those deals. So it was really tough, but it's worth it now because I closed that deal, and I know many of my colleagues closed, and some of you closed during that period, and some of those deals are not standing today. And it's not a coincidence, right? So the macro one, you have to also underwrite what period should I buy, what period should I sell, because there's a period to sell, what period should I refinance. You might not be able to get the full picture of it, but what that would do to you is when you're underwriting, you have it in your mind not to be super aggressive. That's a form of underwriting, because underwriting, some part of it is based on projections. So for you to do your projections, you have to understand the macro market. And guess what? The macro market, none of us here can determine it. So what do? You just create contingencies and take the worst case scenario and run with it. Probability that if you do your stress test very well, you succeed is high if you follow those things. So that is that. Then the next one is the financial one. After I've determined my market, after I've done the checklist for all the things I just mentioned, I have the right employer, I'm in the right season to buy, I have the right community, I have they earn good money, they can afford my rent, then that is one box checked. The next box I'm going to check is now my financials. Now, some of you have seen these things. They call it operating memorandum. These are things that are created by the seller through the broker. There's something called off-market and online. Off-market is that the seller does not want to make noise. It wants to do it at the back end. It's not advertising. It's not announcing it. They'll go codedly to people that they know that can buy and meet with them and say, do you want to buy? That's offline, right? Then online is they have to do all this marketing package. It's more like a pitch deck. They're trying to appeal to people like us. And guess what? It's just like operators. If they want to appeal to you, they'll give you lies upon lies. So this pitch deck is one of the things you should take with a pinch of salt. Now you wonder, why am I still looking at it if BB is saying I should not even look at it? No, I'm not asking you not to look at it because there's some information you can get from it. So you have to look at it, but take it with a grain of salt. Now, what do you look out for in an OM? So an OM will show you different aspects. It's going to show you the property details. It's going to show you maybe the tax information. It's going to show you the rent. It's going to show you the income. It's going to show you opportunities. It's going to show you the macro market. It's going to show you the micro market as well. It's going to show you so many things. All will be looking beautiful. Their intent is not to make it ugly, even if the deal is ugly. That's not the purpose. So that's why you should take with a grain of salt. So since I know that, what are the things I'm looking out for? I'm going to look at the property information. So this is the executive summary. First of all, in a glance, I want to know the number of units. Yes, the broker has told me, but I still want to see it. I want to see the vintage and I want to see the lot size. I want to see the occupancy, just a first glance of what this property is all about. So in a first glance, I can see it here. So this is what I want to see, which is it looks accurate and they're going to show me one of their best pictures. They'll put it there. But you guys know that most times they go and use AI to make these pictures fine. So that's why you have to go visit. So I'm looking at the vintage. So now depending on your criteria, you can decide, oh, this property is not for me, it's for me. Before now, I could do properties in their 50s, 40s, 60s, 70s. But last year I said I'm not going to do any property that is 70s again, except I can only manage to do properties in 70s if it's like blood money. When I mean blood money, I'm talking about cash cow. That is, it's just pumping out money. I'll do it. But if it's just a regular cash flow, count me out. So for me, this is my own particular standard. You don't have to follow me because there's nothing wrong with 60s, 50s, all those type of properties. There's nothing wrong with it. What you actually need, is it producing money? So now the reason why I decided to move from it is because of the repair. That means I have to reserve a lot of money in case anything breaks because these are older properties. As long as you've budgeted that into your capex, you're fine and ensure that the property can cash flow very well. You're good. So I have those type of properties and I have 2000s as well. I have 80s. So please, I'm not saying you should not do it if it appeals to you. I just personally stopped one because of some of my investors. It was difficult for me to convince them to invest in 60s and 70s. So these are things I'm checking. I am checking the vintage 1965, 1970, 1975, 1985, 2024. A property like this, I'm likely to do it, or I'll ask a question. Are these properties separate? Can I buy the 1985 and 2004 and leave the other three? These are the type of information I can get from here. I'll ask the broker. I see you have like 5 different properties with different age. Is the seller open to splitting them? So this is not useless. It's helping me ask a question that can literally meet my buy box. So don't just flip through it and forget. It might be a portfolio sale or they built them in tranches. It might be one property, but the first developer built them maybe in different years according to how he had the money. You know, some people, they have big land, they'll build 1 year, then another 5 years time they'll build another part of it like that. So those things happen. I've decided to start up an underwriting class because it's not going to be 1 week. The minimum for you to learn this is going to take you like months. And I'm saying it because I went through it. Even for the fact that I was a a property manager. I had that experience, but still, it took me time to learn. So we doing it today. We've not even started the spreadsheet. Imagine, I had the plan today to go through T12 because you need to interpret the T12 before you put it in the spreadsheet. The rent roll, you need to dissect and bisect the rent roll. The rent roll will give you a lot of information that you should be wary about. There are some rent rolls, once I see them, I'm out. I don't even need to underwrite. I've seen what I need to see and I'm going. I'm out. So rent roll tells you, gives you a message. The T12 tells you something right before you even underwrite the deal. It can be so obvious that you don't even need to underwrite it. You tell the broker, no, don't worry, I don't want to. Thank you, give me another deal. So that is the level we have to get to, where you can literally not even do a napkin underwriting. You see a trend and a pattern, or you see something from a report and say, no, this is a bad deal. I don't need to see it. I don't need to even underwrite it. So I've decided to divide this class into 3 months, 6 months, and 1 year. Now, the 3 months is going to be twice in a month you have underwriting, and the remaining 2 months you can bring your deal and you have a one-on-one session with me. Let's say you go look for a deal and you've done some preliminary underwriting and you're not sure of it, and you just need someone to have a second eye or even help you improve on it and be sure that what you're doing, you have access to me directly, but it's going to be in a particular period in a week. So throughout the 3 months, every week we are meeting for different reasons. Twice is a general meeting like this, and the other 2 is if you need extra help with your deal. So that's for the 3 months. Now the 6 months one is everything I just mentioned. Aside from everything I've just mentioned, you also have the opportunity to ask us if we're willing to partner with you. So for me, if someone brings a good deal and the deal is from PA, or the deal is from Dallas, or the deal is in a place that maybe peradventure, because 2 of us have gone through the deal, I kind of understand the deal because of the kind of information that we've gotten, and I like the deal. My team and I, we are likely to join you on it. But that is not 100% guarantee. I have to feel comfortable with the market, not just the numbers. The numbers might be good, but I might not like the market. So that one is based on terms and conditions, right? Whereas the last one is everything I've mentioned. In short, I hate that I'm doing this, but I have to do it because this is going to take me time and it's going to take me a lot of effort. But I'm also aware that in different communities that I've been a part of, though I know of, they kind of, I will not say cheating you guys, they are taking advantage of you guys. Currently in my community, for things like that, they're taking amounts from 10,000 to 30,000 to 50,000. That's not the case for us here. Ours is $25. Did you hear that? $25 a month. 3 months is $75, but there's a discount there. So anybody that wants this comprehensive, because I won't lie to you, I'm not going to waste my time to go through this. It's very long, but I can assure you that once we go through this, whether it's 3 months, depending, if you're a slow learner, maybe 6 months for you. But if you're someone that is very fast in learning, 3 months is fine. But if you're ground zero and you really want to learn, 6 months, 1 year, I can tell you for a fact that I will be very committed to you knowing every part of it and my availability. I've seen people giving me deals to underwrite for them. And if you guys notice, I have not been underwriting. I really don't like to underwrite for people because 1, they will take it for granted. And 2, this thing is mental because for me, it's analytical. I have to think. So why will I want to spend my time on that when I have so many things to do and I don't have anything in exchange for that? So I won't do it. So sometimes I see it and I just ignore it. Not because I really want to, but because this thing is mental for me. So if you really want me to dedicate my time to it, which I know this is very cheap, $25 a month, this will have a full session like this. We are going to have, if you have a deal and you need us to underwrite it together, I will jump on a call with you on a particular day. You have my time on that day. All you need to do is to book and you have me. So if we've both done the deal and I tell you these are the loopholes and these are the issues and you still go ahead and do it, sorry, it's on you. BB is not involved. So, and be prepared for me to criticize the deal. I've gone through so many people's deals and I've only been able to pick 1 or 2 out of many deals. So I'll be open to doing that with you, but you also help me help you because you have to get me some information. You have to get me information from your property manager. I will give you some things to do, access to some things. Go and get those information. Now, for the full 1 year one, underwriting is just one part of acquisition. So now you might be able to underwrite a deal, but you don't know how to go through the entire acquisition process. So if you're doing the 1 year one, you will not just have us for your underwriting, this general underwriting, for personal underwriting, you are going to also have us for your acquisition process. So let's say you go under contract. After after we've all agreed that the deal is good and you decide to go with it, you go on it. We're going to walk you through the process. Your LOI, we can help you. We'll ask you what do you want, and we'll also advise you, no, do it this way. We'll advise you on how to make your deal competitive, what to say, what to do. That's that. Then another aspect we also help you with, we can also refer an SEC attorney to you. We'll tell you things, because an SEC attorney will tell you, ask you things that you want to put in your operating agreement. Now, the problem with that is that if you don't know how to safeguard yourself as an operator, you might expose yourself to risk that you don't want to. So because we've done so many of that, I know things that I will ask you to put in to safeguard yourself, or safeguard your investors, or safeguard whatever, even your team. Among your GPs, there are some things I put intentionally to safeguard me personally. Not just that, to safeguard the GPs. Not just that, to safeguard the investors. So if you don't know, they'll just give you the standard and give it to you. So we'll help you through that process. We'll help you see how to negotiate and all that. We'll help you do all that for those for 1 year. So truth be told, it's affordable, $25. Some people, you spend more than that for breakfast or for lunch. I have a lot of team members. One of them is here. I pay her per hour and it's free. We've been doing this for a long time. I've been teaching for almost more than 2 years now on asset management and all that. So you guys know it has always been free. So for me to do this, I said, no, it must count for something. My time must be worth it. So if you're interested in it, scan the QR code, or you check the chat, scan the QR code. Then we're starting the first Monday of March. We'll still be having our normal MFC, but I'm not going to discuss anything underwriting. I'm not going to talk about it. I'm going to talk about other things, asset management, other aspects of multifamily, but underwriting, I won't do that, because I want you to take out something, and this will not cut it, because I won't give my all. I would not. But that other one, I'll give my all, at least because I know that a token is coming from you guys. So please scan this QR code. You receive a message. It's 3 months, 6 months, and 12 months. So depending on you, take advantage of it. If you take advantage, you have me. So let's continue. Let me just wrap up.